JAMODI Podcast. My name is Turner Cavanagh. Thank you for joining us. Today I have an amazing guest, and I'll let him introduce himself here shortly. But today we're going to be talking about the inflation, interest rates, because it's a hot topic right now. So, Joe, tell us about yourself, who you are, where you come from, what do you do? You're a specialist on the mortgage side of getting your home. So let's go in and hear what you have to say.
Yeah, absolutely. Well, first of all, hey, thanks, Turner, for having me. Glad to be here on the podcast and glad for everyone watching. So let's see. About me, I've been in the mortgage business for about 15 years. Started with working for big banks. So Wells Fargo, Bank of America, and just to give you the short version of the story. So spent many years in watching a lot of people not really get the education they need as they approach their mortgage finance and their housing finance. And
because when I bought my first house, I didn't know anything.
Yeah,
honestly, until I got my real estate license, I didn't know. I was just like, yeah, whatever you say.
That's how that's really how most people have been through their experience. You know, they didn't really know any better. They trusted whoever, whatever they were being told, and that's it. And they didn't really have any foundation to really know, okay, is this a good decision? What's best? Yeah. And so through the experience of being in the business during the mortgage meltdown, and on the other side of that, when I was still, kind of figuring out, okay, there's got to be a better way to do this. And so I found myself with the company that I was at the time, and I was sitting there in the parking lot about to go into work, and I just said, you know what, I need to do something different. And so the next day I put in my resignation and I said, you know what, I'm going to start from scratch and build a referral base, do it the right way. Yeah. And so that I made that transition about 7 or 8 years ago, and just started building up my business from that point in through the foundation of relationships, education, and really helping home buyers understand what they're getting into, help them make good decisions, and really not get burned later on and not regret, the purchase that they've made. Okay. So that's a little bit about the background.
That's all new to me. I didn't know.
Yeah,
That's new to me and you guys. So
there you go.
Cool.
There you go.
New nuggets.
There you go. So it's been a great experience since then, and so glad I made that transition. Wish I would have made it earlier, but it's been great. And so now, I just established myself in the local community. So a lot of business that's referral based, just much like how you're building your business, referral based, and just building up the presence. And so, I found when, making that transition, there's just a big gap in the market, because, a lot of loan officers, or especially big banks, online lenders, just focus on the transaction. Yeah. It's like, hey, here's your loan, here's your pre-approval letter, go get a house. But there's no time that's really been invested in the relationship and helping, really understanding maybe the position that buyer is in to give them really good, sound financial advice. Yeah. During that time. So that's what led to that transition.
Okay. So where did you where'd you get your experience from before you started? Obviously in the banks, right? Yep. Big banks. So did you have any education before you went there? And obviously when you were there, you learned a lot of stuff in the field.
For sure.
I feel like I've been learning and have learned a lot from just learning being a realtor in the field, meaning that I got my real estate license and I went out and started making transactions, and I learned what can go wrong, what can go right. So where did you get your base education from to do this?
So I studied business in college, but one course that I got the most out of was a course on personal finance.
Oh, no way.
Yes. And so, and I'm telling you, there's a big gap in personal finance at high school and college, but that was a one elective. I signed up for it and really got a lot out of it. It opened my eyes.
Did you know you were going to do this in the future, or was just
no, I had no idea.
I was just going to pick this one.
Had no idea. So that's cool. So my degree was in general business and marketing, and I was recruited out of college. There's a career day at college. And so we're just going through, talking to all these companies. Yeah. Came across a guy that worked for Wells Fargo, had a great conversation, connected, and he was needing someone in his East Texas office, which is I was from. And so I said, okay, let's do it. Okay. And so went out of college, started working for Wells Fargo Financial. Wells Fargo Financial was basically, during that time, was the subprime arm out of the Wells Fargo Bank. And so we were dealing with clients that, they weren't A-rated as far as their credit rating. So so credit scores may be a little bit low, but we were helping them with personal loans, mortgage loans, even small business finance. If they had a product that needed financing, we'd help them get established so they can, so their clients get financing for whatever the product was. And so that's where I got a lot of my experience in education. Then from there, transitioned into just being focused in as a mortgage loan officer in a call center type environment. And so in that environment, and that time that I made that transition.
In a call center?
Ooh. Yep.
That sounds fun.
Oh yeah. Well, I wouldn't say fun.
Yeah.
But it's but
you had to learn how to do all the grunt work. So you took everything not for granted.
Exactly.
Right.
Exactly. Exactly. But in the call center environment, the one thing is you get a lot of what I would call at bats. There's so many conversations because you got a queue and calls are coming in the call queue, and so there was times where there was just hundreds of people waiting on hold to talk to a loan officer during that
really?
time. Oh yeah. And so this was during a time where money was this is leading up to the mortgage meltdown era. So this is back in 06, 07, and mortgages were easy to get, too easy to get. They were, and so in that environment, it was all about how quick can you take an application and then get a loan structured and then move on to the next call.
Okay.
That's basically what was happening in that space.
So
and that's what
with that being said, were people getting loans on houses that they couldn't afford?
Oh yeah.
Which led to a lot of short sales, foreclosures.
That was a contributing factor.
2008, right?
There's a lot of other things going on.
This is a key thing for you guys to understand to get anything out of this whole podcast is this right here. What he just said, okay? What was the main reason that contributed to the 2007, 2008?
Guidelines were so loose that anybody that had you could say a decent credit score, because you had here's kind of an example what some of the loan products were out there. You had stated income, stated assets. So someone could state what income they had on the application. There was no verification of that income that was necessary.
No verification.
To get so
as long as I make $300,000, but they don't make
as long
80.
as they had a good credit score, they could say okay, and maybe you would have to actually confirm or validate that they had a job or something like that. But there was no verification or documenting the actual income. So there's no tax returns needed, no pay slips, no W-2s. It was stated product. So there was a massive demand from the investor, so the Wall Street side of things that were purchasing those mortgage-backed securities that did not require all those guidelines. So there was a lot of that going on, and there's a lot that was happening in the broker world. So I was not a broker at the time, but there was a lot that just exacerbated the problem in the broker world with not fully disclosing certain things, or there was what they call a pay option arm mortgage product that was out there that you had 4 different payment options. One of them was interest only, and one of them was principal and interest. But there was one option that was neg-am, meaning negative amortization, meaning that it didn't even cover the interest due on the mortgage. So every time you make your payment, your balance on the mortgage increased. But appreciation was happening so rapidly in certain parts of the country that's, people like, oh, well, I'm just going to obviously pay the smallest number on my option payment. But because my home is appreciating faster than my mortgage balance is increasing. So they were justified. That's how they justified that loan product.
So by the time, we'll just say like 2006, they get their loan approved, right? And then fast forward into where the crisis, the bubble, the meltdown happened, right? Was it 2007, 2008?
2008. 2007, yeah. 2007 was kind of leading up to 2008 when it really hit.
That's when, for those situations, where came the short sales, the foreclosures, all that stuff, right?
Yep.
Is that how you would explain it? That's what happened during that time. That's when a lot of people relate to.
A lot of people.
They try to compare what they think is going to happen, especially in Dallas, Texas, which I think is completely different than a lot of other cities in the United States. Is that they're completely 2 different scenarios. I know I'd like for you to elaborate on it. I have my little spill on it, right? I like to educate and inform my clients, friends, and family about this, but it's completely different from the life, what happened back there in my generation that has experienced it, right? So they're all going to refer to what happened back then to what's happening right now, which is completely two different things, meaning that we're not having that situation. We're having a population problem, which brings, I'm stuttering there for a second, which brings, a supply and demand problem. Okay, we got all these influx of people coming to the hotspot of Dallas, Texas, and there's not inventory for them, which drives the prices up. But people think that there's going to be a bubble pop. Now, it might cool down. I want to hear your side. Okay?
Sure.
I think that, I don't think just the stuff that I've been educating myself of historical data, not just me, my opinion. I believe that it's not going to really cool off in Dallas for quite a while. And the reason being is, one, Dallas is always the last to be hit when it comes to some crisis like this or bubble popping and stuff like that, because we're so strong. There's so many people who want to come here. Two, we have a problem of population. There's more people in our homes. And so that's kind of like my take on it. And then obviously we'll get into the interest rates here in a second, but that's a whole nother ball game. But what's kind of your view on comparative to what happened in 2007-8 to what now, or what's gonna quote unquote happen? What could happen?
Yeah. So
they don't relate, right?
No. We're definitely not in a housing bubble. So I know there's a lot of talk about that.
It's the media that wants to headline it, right? And that's what our clients, friends, and family see. They're like, well, I'm going to believe everything the media says, which is obviously not the thing, but it's not going to pop. There's no needle.
So you got to look at, really what's driving the housing market and what are the fundamentals behind it. So it's the biggest factor is supply and demand. So there's a lot of demand.
A lot of it.
There's not a lot of supply. So what's driving the demand? Well, for one, the demographics. So the millennials they've entered their peak buying, home buying age. So they want housing. They're having kids. They're married. They have stable, solid income, and they're in a position where they want to buy it. That's a big driver of the demand. The supply issue is that sellers are kind of holding on to where they're at because they don't know. Okay, what if I sell? I don't have anywhere to go. So that's part of the issue. So now the reason that we're not going to see any kind of bubble is because we've seen a mortgage or real estate appreciation. Let's see, even the past year, like 32% in the past year. And so homeowners are sitting on a lot of equity right now. So rewind back to the mortgage meltdown, that was not the case. People were underwater. So people owed more than what their property was worth. And so a lot of people just let it go. They had to walk away.
That right there is one of the biggest keys there. And I'm going to definitely make a graphic or something on this video that highlights that. That's what the meltdown that happened back. I like how you use that word. The meltdown that happened there, and then the quote unquote people say the bubble today.
Right.
They don't relate.
No, they don't. So there's just too much demand. Rent isn't any better.
No.
So the rent prices are continuing to increase. And people understand there's still a lot of value in owning. So they want to take advantage of the appreciation they've seen. That's not going to slow down. The demand's still going to be there. The guidelines have completely changed. So the problem that led to the issue back in 2008 is those problems have been, you could say, solved for the most part. The guidelines got a lot tighter. So everybody that is in a mortgage, they very well are deserving to be there. They went through a lot. They went through a lot of underwriting to get there. And which was not the case before. So they've met income qualifications, they met credit, met asset, and so we're not really in that same situation where there are homeowners in a mortgage position that could not afford it. So people that are homeowners, they're affording it, but they're sitting on a lot of equity, and so they're not gonna walk away from that. And so there's the foreclosures. I think there was a lot of question. Hey, is there going to be a spike in foreclosures after the pandemic, after everybody comes off the forbearance? And that has not been the case at all.
No.
So it's there were a lot of people that took advantage of forbearance because it was just open for anybody and everybody who had a mortgage. But a lot of people even though they went under forbearance, they didn't necessarily have to. It was just there to take
Yeah.
advantage of it,
Mhm.
and no big deal. But there's very few very few of those scenarios that are resulting in an actual foreclosure.
Yeah. So do you think that let's talk about the Dallas DFW. Sorry, not just Dallas, but Dallas Fort Worth, for you Fort Worth people out there, the Dallas Fort Worth people, the market. How do you feel like is it going to slow down in time? Is there or house is going to decrease? Now, that's a big question,
Sure.
right? Because that answer right there will tell you what you're going to do next steps, or you're going to sell, you're going to buy, you're going to keep, whatever.
Right.
I've had a lot of clients say, "Well, I'm waiting for the prices to come down."
Sure.
I personally don't think they will, but I want to hear your side. These are all fresh, hardcore, real conversations. We didn't talk about this stuff before we pushed record on this, so
that's
right. I want to hear your
absolutely.
Answers.
So that is a very common question. I'm getting that question a lot as well, and so you got to go back to, okay, well, what is going to slow down demand?
Mm-hmm.
There's really no factors that are going to all of a sudden shift where the demand's going to go away, or is there any factors that's all of a sudden going to bring supply up to meet the demand? And no, there's really not. Their builders are behind. Builders, closing dates are being pushed out, sometimes months behind schedule. There's still supply chain issues that
I experienced that myself.
There you go.
Yeah.
So there's still supply chain issues contributing to the problem.
Mm-hmm.
So when you have those factors at play, that is going to sustain real estate prices. Mm-hmm. We will see it maybe get back into more of a normal market. That's kind of what we're seeing right now.
Meaning that, elaborate on that. Meaning that the houses the people won't be selling houses way overpriced. What do you mean by that?
Yeah. So in a normal market, there's more bounce. So right now, it has been heavily weighted to a seller's market, heavily, where buyers have to give up everything, all the contingencies, go way over list price to get their offer accepted. So when I say normal market, things are maybe getting a little bit more in balance, where maybe instead of 10 offers on every listing, there may be 5. Mm-hmm. Perhaps maybe instead of having to go so far over list, maybe you could get something under contract closer to list price. Mm-hmm. So we're starting to see a little bit of a shift in that direction, where now it's still very competitive. It's still very competitive in Dallas Fort Worth, but we are seeing just a little bit of a cool off, which is a positive thing, because this is giving buyers more of an opportunity to get into the game.
Yeah.
And so that's one key right now is if you're a buyer and you're sitting on the sidelines, you're still gonna if you're looking at that same property a year in the future, it's still going to cost you more than what it is going to cost you today.
Yeah, and that's based on historical data of house appreciation. Mm-hmm. The average appreciation a year was it 4%?
Around 4 or 5%.
Obviously, in 2020, 21, it went up to 14%, right?
Oh, even more than that in certain pockets.
So we're kind of cooling that back down. Yeah. So, I mean, regardless, the words I've quote unquote used, I got from someone else, my great leader, Travis Hitt. You will pay for waiting. You will pay for waiting regardless.
For sure.
And that's always been the case, really, in real estate, especially right now. We'll get into the interest rates here in a second, but that's another thing is people were like waiting. Well, I want the price to go down on the home. Well, that's not going to happen.
No. Any advice I give, especially young people, first-time home buyers, is just buy a house as early as you possibly can afford to.
I wish I had somebody say that to me.
My son is 18 years old, and I'm telling him right now, I said, as soon as you possibly can buy a house, buy a house. Get some good solid roommates in there.
Yeah, they pay half the mortgage.
Offset the mortgage, and then do that process over and over and over again. So that's that is some of the best advice, because this real estate is still, I would say, the number one way to accrue wealth.
It's 100% agree with you on that. So I'm right there with you on that.
Yes. Yeah. So I wish I would have taken that advice even
right?
early on.
Dang it. Well, let's jump into interest rates so we can keep people interested. But so let's talk about the rising interest rates. I mean, from December to now, they've gone up almost 3%. I want you to, since you're the professional and expert on that side of things, I just educate my clients, just like we're doing here, to help everyone watching this podcast take that positive step forward in their financial life.
That's right.
I want you to. I feel like it's going to go up, right? But I'm going to say what I always say to my clients is, they will go up, but they will go back down, just like historical numbers in history. It's happened. I was looking at this chart the other day. It went back all the way back to the 70s, and it showed every year the interest rates, and it was kind of going up like this. But the factor is that you can refinance when it's lower. So let's talk about where is it going, what things people can do to prepare themselves if they are buying, what they can do after they purchase, things like that.
Yeah. So, well, you mentioned that the kind of the historical interest rates. So if you go back to the 70s, average rates were probably around 8.5%. In the 80s, the average was 13% average interest rates. You go to, let's say, the 90s, they came back down maybe around 8 or 9%. Yeah, 8 or 9, and then maybe in the 2000s.
I feel intelligent because I just know these numbers.
There you go. Nice. And then let's say in the 2000s, maybe around 6-7%. 2010s, we got down to maybe the low 4.25% range. And then we just got spoiled during the pandemic. Yeah, we saw rates in the twos, and that was the Federal Reserve. They changed monetary policy. They wanted to stimulate the economy. Started pumping a lot of money back in the economy, purchasing mortgage-backed securities, and that kept interest rates low. And so that's really what, anytime that there is something threatening the economy, Fed step in and they take action to help keep it going. And that's basically what they did when the pandemic started settling back in March, April 2020. And so we got spoiled. We had 2 years of super low interest rates. And so now we knew rates were going to go back up. We knew that was going to happen. Now, the reason that they're going up to the degree that they are right now is because inflation numbers are higher than what was expected.
Okay.
And that's just due to the all the stimulus money that the Fed's pumped into the economy. It really had a little bit of an adverse effect than what anybody anticipated that it happened. So that's where we're at right now. So, so as far as like you mentioned, it's a temporary scenario that we're in. Yeah. So the only reason that rates are as high as what they are is because the inflation is where it's at. And so as the monetary policy changes, which is definitely underway. So we've all seen the news. The Fed's increasing interest rates, and that's the federal exchange rate, which doesn't directly impact mortgage interest rates, but it does impact. Inflation is really what's having a more direct impact on mortgage interest rates. So so let's say after the economy is cooled down as a result of the Fed monetary policy. Yeah, we'll see monetary policy change. And so once we're in a recession, which we're kind of heading in that direction, and that's intentional from the Feds for the most part, they have to slow down the economy, and that's the definition of a recession, when there's a pullback on the purchasing of supply and goods. So when that shift happens,
so that's basically like the home. So they basically raise interest rates to do that.
So the inflation is going to impact.
I'm educating myself too here. So this is great stuff.
So inflation is impacting all sectors of the economy.
Yeah.
So if you look at, food and energy and travel, and just, so real estate is one sector, and it's the consumer price index. That's what kind of tracks what's happening as far as inflation, what is showing in a numerical percentage of what's happening. What is the cost of pricing goods compared to what they were a year ago. And so right now, the most recent report that came out had inflation numbers at about 8.4%, I believe.
Okay.
And so that's kind of average on all sectors, but there are other sectors that have a lot higher spike in the cost of the percentage year-over-year change. So I think food is like maybe 10-12%, energy is like 50%, cars are maybe between 12 and 20%, between what's a used or a new car.
Yeah.
Real estate is big, so that's like 20%. Rent is going to be a big year-over-year change. And so when you look at the whole, that's how we get to that inflationary number of about 8.4%. So so once that gets a little bit more under control, then we're going to see interest rates come back down.
Yeah.
And then that's going to create the opportunity to refinance. So that's really the plan. So the plan is going into, let's say if you're a buyer in the market right now, and that's the one thing that's keeping you on the sidelines is, well, I don't want to buy right now because the interest rate's high. The cost of the mortgage is a little bit higher, but if you wait, well, you're just going to be paying more for the property,
the principal of the home.
You're going to pay more for that same property in the future. And then once interest rates come back down, we can have a plan to refinance to bring the cost of the mortgage back down. So if you have to have a place to live and you know where you're going to be, and your alternative is to rent, then that's when you really need to drill down to, okay, what is the true cost of renting over this time period compared to maybe the cost of buying. And we can run the analysis.
Yeah,
so we can have analysis on cost, rent versus buy. So you have the numbers.
Yeah, because it's like, I always like to say, it's, renting is 100% interest. You're paying a mortgage. It's just not yours.
Exactly.
So, if we had a buyer sitting right there between us, a little sandwich here, okay, and you wanted to give him a couple nuggets, all right, about if you're a buyer on the fence, I want to rent because the interest rates are so high and the house is so. I want the prices come down before I buy it. What should I do, Joe? I knew you smiling on.
So for one, I would say, hey, take the emotion out of it, because they're probably buying into everything they're seeing on the media, everything. Maybe their friends in their ear say, hey, you need to rent, so they need to talk to the people who is going to give them the best advice. So they need to connect with not just any realtor, but they need to connect with a professional, someone that knows what they're doing, but also on the mortgage side as well, that can help them understand what's happening in the market, that has experience, that's been in the market long enough to see that they've seen and experienced the cycles, the ups and the downs, and then look at kind of drill down to their specific scenario, their specific case.
Yeah.
And so it's all about the question. So
running the numbers to go
That's
to
right.
them.
We just look at the numbers. We just break down the numbers, get a real true picture of where they are at financially. We ask the right questions to understand what their goals are, but also what short term, but also long term. Are they going to be in the area for a certain length of time?
Yeah.
Do they have an appetite for perhaps, let's say if they did have to relocate within a year or two, do they have the appetite to maybe hold that property as a rental for a long-term asset? So we kind of have those conversations, give them the best advice, and make sure they understand the pros and cons.
Yeah.
And so, and there may be, and I would say more often than not, it does make more sense to purchase rather than rent, because rent prices, they're continuing to increase. That's one of the biggest hedges against inflation, is to lock in your housing expense, and you can't do that with rent.
No,
there's no way.
It's just going to go up.
Exactly. And it's going to go up at the exact same pace as real estate prices are. If not more so.
I was looking at an ad the other day for a 1,600 square foot apartment in Uptown. I believe it was like $3,200 or something like that. That's almost $42,000 a year. You're just paying basically interest
with nothing to show for it at the end of the year.
No.
So
I mean, I think I wish I had these little nuggets when I was younger, dude. Bro, it'd be
exactly.
It'd be awesome, but I didn't. But here we are today,
right,
educating you so you can. What's one other nugget you would give that buyer right now? Like say, educating wise, that person you talked about locking in your own mortgage, your rent to yourself.
Lock in your housing expense. Hedge against inflation.
Yeah.
So you're not subject to the rent increases and paying somebody else's mortgage.
Exactly.
The second thing is really look at the return on your investment. So buying a house is an investment. The amount of an investment is the down payment. And when you look at what that property is gonna grow to as far as appreciation and what kind of return you can get, really look at that. So it may cost 5% down. Just do the math. 5% down on a property. What is that dollar amount? But then what are you going to gain in equity over that year? And what is that, how great of a return is on, and we can calculate those numbers to you. And if you look at the down payment, let's say a couple of years ago, and the return now, hundreds and hundreds of % return, because your equity has, quadrupled.
You'll be able to compound your wealth.
Exactly. So it really is an incredible path to adding to your net worth through real estate.
Okay.
And it's just a matter of making sure that you're making good decisions, and you just got to connect with the right people to help you make those decisions.
Right.
So, yeah.
Well, I appreciate you giving us all these good golden nuggets.
My pleasure.
Before we hop off here, I want you to educate people on how they can find you and how they can get a hold of you.
Yeah, absolutely. So you can email me anytime, joe@robinetteam.com. Email's great. You can find me on social media, whether it's LinkedIn, Instagram. You can connect with me there. And
Joe Robinett.
Yep. You just search Joe Robinett. You can find me.
Okay.
And but yeah, happy to connect, answer any questions you may have, and make sure you're making some good decisions.
All right. Well, thank you guys for tuning in. I appreciate you. As I always say, JAMODI. It's just a matter of doing it. Take care.